morning and get into today's Monday morning mortgage update and market update. The biggest thing we want to hear of kind of what happened this last week, our predictions were hopefully that the Feds would have a nice dovish tone to their speaking last week. And let's see what we got. So let's jump into this right away. So first off, what happened last week, and we'll go over kind of what rates did as well. So Japan has been in a negative interest rate environment since 2007. So some big news, they finally got out of that negative interest rate policy last week. It's the first time since 2007 that their Fed funds rate, basically what mirrored ours, kind of what they do internally, is now at 0 to 0.25%. So don't know what that was going to do to the markets, but actually the bond market liked it. So that was good. The unemployment rate ticked up a little bit. We're at 3.9%. The Fed funds, the Federal Reserve wants the goal of the unemployment to be 4.4. So we're still about 0.5% off what their goals are. And I believe that they're going to start cutting once we approach that. I don't think they're going to care too much about inflation. They have a dual mandate, inflation and jobs. So I think inflation's kind of stagnant right now. I think they're going to focus more on the unemployment numbers, which we've been talking about for a while here, before they start cutting. And that's what one of his things he focused on was how many cuts. So based on what he's said and what other Fed chairmen have said, is that the expectation for cutting is going to be 3 cuts instead of 4 or 5 for the remainder of the year. So at first it was 6. Then it was 4 to 5. Now we're at 3. Will it become 2? Who knows? We'll have to see what the jobs numbers show. But that's kind of what happened last week. The markets actually liked what the Fed had to say. The bond markets did. And so we saw a little bit of improvement. But here's the dot plot. This is each one of these dots represents one of the Federal Reserve governors. So we have right here the 2. So in this case, in 2024, if you look at this is based on the Fed funds rate, 5.5. 2 people believe there'll be cuts below to 5.5 to 5.25. 2 people believe that it's going to be in a cut to 5.0 to 5.25. A lot of people believe there's going to be 3 cuts. Some people still believe it 4, and nobody believes there's going to be more than that. So this is interesting to see kind of how many cuts the Feds are expecting and who's voting for each. So between 3 and 4 cuts is expected, but look how many times they're going to continue to cut into 2026. So the Fed funds rate expected to be down to 3 to 3.5, maybe right in that range, and holding. That would be really, really good for mortgage rates. So interesting, because a lot of these dot plots looked more like 2025 instead of where we are right now. So it's interesting to see the changing of the mind, so to speak. So what is this doing to mortgage rates? What is happening to mortgage rates? Well, let's have a peek. These are the candlestick charts, and this was 2 weeks ago. Wasn't good. We had some inflation numbers that were higher than expected. And then we had last week, which was these 5 days right here. We're flat. We held on this 100-day moving average like magic. Isn't it crazy how the bond trading just stops on these? Then we went above the 25-day moving average, and that was a really good day. So we had some good news from when the Feds spoke, and overall it was a very good week. And then we ended the week on Friday up here. We started today kind of flat. And I'm going to take you to another screen real fast. This is the live chart. We're still kind of flat, but I want to show you the 10-year, because this does influence everything that the 30-year is doing. We were below, and we were right on this which is the 200-day moving average, and everything's kind of tangled up right here. So we're right in the middle of this mess. But the 10-year actually spiked, and now it's above this moving average, which is believed the 25-day moving average here. And there's a lot more room without much resistance for the 10-year to increase. So we're going to watch that carefully, because if the 10-year goes up, that forces the 30-year to go down. So if you look back at now the 30-year, we have a little bit to move down, but if we pierce through beneath this, then we may go further. So let's hope that the 10-year holds and it doesn't go any higher. And let's hope that we can get this 30-year to continue to go upward in trajectory, which would mean better rates for us. So that's kind of what's happening with the markets. Let's kind of see what that's actually doing to interest rates. So let's jump into that now. So this is, I like this, but I don't like this. This is if you go to Google and you just put in mortgage rates, it'll give you a calculator on what the average interest rates are for the industry. Now, it doesn't take into account what you can get. You can buy the rate down. You can do a lot of different fancy things. But the 30-year fix, we dropped into the sixes again, so that's really good news. 15-year, we're a little bit lower. Now, the 30-year, it says 7.05, but to get to 6.125 doesn't take too much. So you can get actually a pretty good FHA loan right now with just a little bit of discount points. Same with VA. So don't let this scare you. We can get into the sixes really easily with that, with just a little extra in cost on the FHA and VA as well. Jumbo's kind of in the same realm. Depending on the investors, they kind of lower and raise their rates to get more volume. And that's kind of how the mortgage banks work. But now we talked about lower rates. We think mortgage rates are continuing to drop, but look at the change of pace that everyone has predicted, right? The dots are what they thought at the end of last year, what they thought rates would do. The solid lines are what now their new crystal ball, what they think they're going to be doing for the future. So if you look at what Fannie Mae in the orange or the brown, depending on what you're seeing here, they were thinking we're going to be Q3 in the low sixes, and then they thought Q2, Q1 of next year we're going to be in the fives. They've changed their tune. Everyone realizes inflation is stickier, and we have a higher prediction now on what rates still coming down, but it's going to take a little bit more time. And if you extended this into 2025, you would see it dipping even further. But this kind of shows you those people that were wanting to wait, well, they probably shouldn't have now, because rates aren't going down as fast as we all previously thought. But that does mean rates, like if you look at Mortgage Bankers Association, still believe rates are going to be in the fives by the middle or beginning of next year. So it'll probably end up somewhere in the middle, but that's kind of the new trajectory of what people are thinking now that we have more data to review. And we're seeing that inflation is a little bit more stickier than we want it to be. So here's a new report. This is a report that I do with all my buyers. So if you have a buyer and we're looking at different rate options, looking at different strategies for making offers, this is one of the reports that I show. And now this is just a snapshot, but this will show you exactly kind of what some options are when making an offer on how to get your payments down. So this is based on an 800 purchase price. This person was putting 300 down. So this is a pretty good buyer. I mean, they've got a good chunk of change to put down. So mind you, everyone's different, but they're looking at what it would cost if we used a seller credit to pay closing costs and do a small buy down. So buy down by about a quarter to 6.625, but pay for all the fees. So down payment of 300,000. So they would have literally 300,000 out of pocket. What does that look like compared to doing a permanent buy down to 5.875, and then or compared to a 1 year temporary buy down where you're buying down the rate both permanently and you're doing a temporary buy down, and we're at 5.125 the first year, and then up here you'll see for life the second year, and the remaining is you're at 33.72 or 73. That's the payment for the remainder of the term, compared to a 2-1 buy down, which gives you the absolute lowest rate, 4.75 the first year. Now we look at these charts, we look at the monthly difference, we look at the savings over time, we look at the interest you're paying over 15 years, we can adjust this to match their goals. But it isn't always about what is your rate, because it's all up for negotiation based on what the seller is willing to give, whether they may not want to give anything at all. But you don't always have to get that vanilla rate at no points. There's a lot of options. We illustrate that beautifully with these reports. And these are very interactive. I can change on the go with the customers. They see it on my computer. I can actually highlight on my side and it highlights it on their side. So it's interactive. It's super cool. But this just is to show you, even though rates are in the high sixes right now, we can still get borrowers into the fives right now with a permanent rate buy down, or even lower with temporary rate buy downs. So now, mind you, if you don't understand the temporary buy downs, the 3-2-1 buy down, the 2-1, here's a simple way of putting it. The sellers give you money. They give the buyers money. That money sits in a separate account. Every month, you dip into that to supplement your payment to make it look like your mortgage is equal to a rate of 4.75. When in reality, it's always 6.75. We dip into that fund and we supplement the payment to make it equal to a rate of payment at a rate of 4.75. Every month we dip into that account. Well, let's just say 6 months goes by. We still have a lot of money in that account and we refinance because rates drop to 5.5. You can refinance that loan into a permanent 30-year fixed, and whatever money you still had in that little account gets refunded back to you by lowering your principal. So there's some really good options on temporary buy downs if the rates drop within that period. So if you want further information on that, I can give you a one-on-one. I'm actually going to be making a lot of videos. And thank you for your input. Those of you that sent me an email responding to my question as to what videos would you like to see for very short, less than a minute videos to help you and your buyers understand the mortgage options in this market. So if you have any ideas, put them in the chat and I will put together some videos in the next couple of weeks. So we need to know this. You guys need to have this handy. This is the max seller contributions you're willing to ask based on the loan type and based on the down payment. So memorize this or print it, put it in your pocket, keep it. So because when you're making offers, you're going to need to know how much you can ask the sellers to do these buy downs if that is an opportunity to do so. You don't want to ask for 6% and then realize you can only use 3%, because then you'll be kind of left. Now, if they give it to you, you get the 6%, but you realize you can only use 3%, you can always renegotiate the price and have them lower the price by that amount instead. But this is a really good way of understanding what you can ask for. Now, appreciation. What is going on with appreciation right now? Diana Olick, bless her heart, she's on the news every day talking about what's happening in real estate. And she always has a doom and gloom portrayal of what's happening in the markets. So today she went on and she said, oh my gosh, the median price of homes is dropping significantly. Now, if I'm a consumer, I'm going to hear that and go, oh my gosh, prices are going down. But we need to really understand and educate your buyers, your sellers, what median home price is. And here's why. This is a chart of what the price ranges are of homes that are selling right now. Now, the question is median value versus actual value. Can you have median home values drop while homes are appreciating? And the answer is yes. And this is why. Median home prices are a graph, basically, on what price ranges are selling most. That's it. So if you have homes appreciating like crazy, but more homes are being purchased in that 400,000 range than $1 million or than 500, 600,000, that graph is going to show that more homes are selling in that price range than anywhere else. So if you have $500,000 homes selling more than $400,000 homes, your median home price of homes that are sold, the average sales price of homes sold is going to be closer to 500. If all of a sudden more people are buying on the lower end, that means it doesn't mean the values are dropping. It just means that the average sales price, median sales price of homes that are popular right now is lower. It doesn't mean values are dropping. It just means that for some reason, like look at this chart. If you look in price ranges on the first green column, the 200 to 299. Now this is national, by the way. You're going to see that in December, 7 was the number. And then in January, it went to 8, and then it went to 10. And then in the 300, there was 20 homes, I mean, this is multiplied by thousands of units, by the way. 20,000 homes sold. So 20,000 homes sold in this price range compared to only 10,000 homes being sold in the 400 to 499 price range. So it's going to look like the median sales price average dropped, but it doesn't mean values have dropped. But Diana Olick makes it sound like values are dropping, and it makes it sound doom and gloom. And that's what your customers are going to hear. So they need to be educated on what median sales price, what homes are popular right now versus what values are actually doing. Now I'm going to show you a next chart on what appreciation factors people have predicted. And when I say people, I mean institutions have predicted versus their new predictions because they've changed. So I'm going to show you what they were predicted in 2023, or what year we are. Oh my gosh, yeah, 2023 compared to 2024's new averages after collecting data and seeing the first quarter, kind of what homes are doing. This is really interesting. The blue is what their appreciation forecast was for 2024 last year in 2023. So Goldman Sachs said that was going to be just under 2%. The Mortgage Bankers Association said appreciation value is going to be just over 1%. Zillow said it was like 0.3. Now, we all know Zillow nails it every time, right, guys? Yeah, no. Fannie Mae actually is my favorite person or entity to look at in predictions because they hold all the data. And they were in the high 2s, and now they're above 3. Freddie Mac, same thing. They hold a lot of data. They were in the high 2s, and now they're a little bit higher and a little bit closer to 3. The home price survey was in the low 2s. Now it's in the mid 2s. As you can see, the trend, everyone is now updating their forecasts based on what people are doing with rates still being high. As we continue into the year, we're showing appreciation average right around 4%. So super excited for that. We need to make sure our buyers and our sellers understand this. But we are seeing appreciation at pretty good levels, even though interest rates are stubbornly high. So that's very, very good. Now, one of the things I want to share with you also is we all have those buyers that are still waiting. They're like, I'm just going to wait for rates to drop. Well, if it's going to take longer for them to drop now, what is the true cost of waiting? So I have a nice little screen here that I'm going to show you again. Here, let me just open that up real fast. This is a cost of waiting calculator that I have that I can help you guys put together based on your buyer's specific needs. So, hi buyer, and we can customize this. It can be co-branded as well. Here's how much waiting will cost you. So it has a nice little graph here that shows what the appreciation and the amortization is expected to be for the year. Appreciation over the year is going to be about $28,000, plus the money you've paid yourself through that mortgage is going to be about $5,000. So your total, you're just under $34,000 positive in personal net worth over a 1-year period. Okay. Now, if you look at the rest of it, as far as appreciation, half a year at 18,000, this just kind of takes it into more consideration. And then the net cost of waiting, if you had to refinance, you're still in the, if you waited, you would have lost $27,500 if you would have waited to buy. Now, to me, that doesn't make financial sense. This doesn't even count how much you paid in rents that were lost, but that's neither here nor there. Here's a nice little analysis of it, kind of showing all the numbers behind the scenes as to where it would actually look like. If you waited 6 months, the same down payment would be $6,000 or $4,000 more because your appreciation. After a year, it'd be about $6,500 more out of pocket for down payment. So overall, it costs money to wait, even if you got a lower rate. So knowing that, and again, this takes into consideration the rates dropping. So even with lower rates in the future, it is better off to buy now versus wait. This is a great illustration if you have any buyers that you're working with right now, to show them the numbers, because it's hard to figure that out. And just thinking about it, if you wait to buy anything, if you just think I can get it cheaper later, yeah, you can, but what is the cost during that waiting period? That's what they don't think of. So anyhow, I hope you guys like these. If you need a custom version of this, I'm happy to do that for you. And I can absolutely help you guys with your buyers understand what that truly means. So we've got rates coming down slower than expected. We've got appreciation happening, which is more than expected. So what does that mean? That means we are in a place where it's time to buy. So make sure your buyers understand this. If you guys want to do a little course, a little buyer consultation, whatever it may be, to understand kind of what the markets are doing, or you can just share this with your customers. Lower rates plus appreciation equals buyers win. If you buy right now, you can always get a lower rate in the future by refinancing, but you're going to get that appreciation as well. So excited. Let's see what's happening this week. See what we can expect for rates moving forward. So here's a little breakdown of what's happening this week. We have new home sales units coming out, supposed to be higher than expected, which is a good thing. Durable goods, it's supposed to be a little bit positive, but it's still not very good. Consumer confidence is supposed to be flat. GDP, we're supposed to be about equal. Nothing, it's kind of like the same old, everything's going to be relatively blah. Initial jobless claims, look at this. It's expected jobless claims to go up a little bit. We want that. That's what's going to help the Feds really push forwards towards lowering the Fed funds rate. Chicago PMI, it's going to be a little higher, no big deal. Consumer sentiment, equal. Pending home sales change, we're up. That's a good thing. This is the big one, guys, the PCE, the personal consumption expenditure. It's the Fed's favorite gauge of inflation. Now I've seen different things. I've seen some predicting it's going to be hotter than expected at 0.5. Some people think it's going to be 0.3. I hope it's 0.3. That means inflation's coming down and it'll really help rates. If it's 0.5, could be bad news. So we're going to really, really watch that. That's this Friday. So Friday could be a market mover for us. It's going to be relatively flat through the week, depending on what happens with the 10-year. But expect to see relatively stable rates this week, except for on Friday. That's going to be a big mover. So that's my presentation for today. I'm going to go ahead and stop sharing my screen and then jump into any questions that you guys may have in regards to what's happening in the market and what I can do to help you guys plan for this week. The chat is open, and feel free to just unmute yourself and go for it as well if you have any questions.
Thanks, Sean. Thanks for the reminders and the education. Always appreciate it.
Oh, my pleasure. Yeah, my pleasure. Anything you guys need, I've got a lot of stuff. So if you're just kind of baffled as to what to do next in your marketing, let's brainstorm. Don't be shy if you have any questions.
Okay, thanks, Sean. It's Melissa Gasper.
Hey, Melissa.
Sign off.
Have an
Have
awesome
a good day,
day,
guys. Thank you. Bye.
Hi, Sean. I have a buyer. She's not ready yet, but she wants to know what she needs to do to be ready. So I asked her if we can have a phone call maybe next Monday.
Absolutely. Yeah.
She's only available Sundays and Mondays. She just
Okay.
started working. She's making about $6,000 a month.
Okay.
So she's very excited, but that's with overtime. So it's $20 an hour.
Okay. So just right out of the gates, if you're making about $6,000 a month, your total debts can be about $3,000. So kind of an easy way of kind of gauging 50% of what you make is kind of what your total payments on everything can be. But we can kind of go over what that looks like, what the next steps are, and help her get really excited for purchasing here in the future. So yeah, I'm happy to do that.
So this is a scenario. She just started working. She just legalized in the US. Her son was born here and he's going to school, but he's going to start working as police enforcement.
Okay,
He's going to be making, I think, $34 an hour.
okay.
So I told her sometimes the school counts because he's really going to start working. So how soon do you see? I don't think she has any debt because she didn't have and she wants to know also if she should start opening credit cards. And I told her to wait until we talk to you.
Yes, we can have that conversation to see kind of what she has currently and then figure out what the next steps are to build credit. There's always alternative methods for showing underwriters credit history, and that's with your auto insurance, any other type of long-term commitments you have, maybe like a gym membership, if you pay utilities or something like that. We can prove that as credit history as well. So yeah, let's kind of figure out what her baseline is, and then we can figure out a plan from there.
Okay, sounds good.
Yeah, that'd be great.
Maybe next Monday, would it be better before this meeting or after?
After, definitely, because I prepare everything. I start about 5 in the morning and I get everything
Oh.
ready based on the new data. So the mornings before this I'm knee deep in data. So
It's better after. Okay,
Yeah.
sounds good. Thank you.
you got it.
Have a great one.
I will. Thank you so much. All right, y'all have a fantastic day. If you don't have any further questions, we're going to go ahead and end this session, and enjoy your week, and we will be in touch.
Thank you so much, Sean. Appreciate this is great info.
I'm glad it helps. Thank you very much.
It sure does.
Excellent.
All
Have a
right.
great week. We'll talk to you soon.
Okay.
Bye-bye.